Welcome back to the channel, everybody. This week we're taking a look at DCF valuation of AMD. Check out our last week's video if you want to learn how to determine when a stock is value or growth, but today is evidence-based. We used full financials for AMD and did all of our research to ensure that all the metrics are as accurate as possible. And today we're going to use all of that information and use our DCF template to fully do a discounted cash flow analysis and give you guys a full rundown on what the fair stock price of AMD is. And I really hope you guys can use this to do your own analysis on your own stocks in your portfolio to determine if they're over or undervalued. So hope you enjoy this one. It's a really good one this week. Enjoy it, and I'll see you all next time. We are taking a look at a discounted cash flow valuation based on last week's video where we talked about value versus growth stocks and Warren Buffett's style to investing. So today what we're going to do, I've chosen AMD, or Advanced Micro Devices, which is a company that was founded in 1969. And we're going to actually be using this company and using all the fundamentals from their financial statements to fully derive their stock price and their fair stock price, compare it to its current stock price, and from there come to some kind of conclusion as to how we're going to price it and if you should buy it or not. Okay, so let's take a look here. So we've gotten all these figures here. We've provided a document alongside this to kind of give you guys a better idea of how we got all these values, since they're not exactly easy to come by. But essentially the corporate tax rate here is a mix of state and federal tax rates, which for AMD's case, it's based out of California, which was 8.84%, and 21% federal. We've actually mentioned that over here. So that gives us that combined 29.84%. We've also included the risk-free rate, which is a 10-year yield on a 10-year treasury bond. The market return, which is the average 42-year return of the S&P 500 index. The cost of debt, which is the federal funds rate. As of right now, it's a little bit higher, of course, with inflation battling. The beta, which is actually a measure of risk, was taken from Yahoo Finance. They actually give great data on this, as well as the GDP growth rate, which was also obtained from Yahoo Finance, but this was from a different section talking about US average gross domestic product growth over the last 50 years. The enterprise value to EBITDA was also found on Yahoo Finance. This is a great place to find it. It's usually fairly accurate, so we've taken that from there as well. The value of firm equity was taken by getting the total amount of assets and liabilities subtracted from the total balance sheet value. So we're subtracting the liability section from the shareholders' equity, and then we end up with this. And the value of debt is that excluded value that we had before from that balance sheet. Again, in that document, and I'll link it in the description below as well, where you can get AMD's financials. You can do this for yourself as well. And then we have cash and cash equivalents here, which is just over $5 billion. Again, all these figures are going to be in millions of dollars, so just keep that in mind. We also have marketable securities here, which is similar, but it's short-term investments. We have no short and medium-term debt as far as their financial statements told us. Their long-term debt here, as well as their most recent EBITDA as of year-end 2022. Okay, so now that we've got all of that, let's get started. So just a quick disclaimer here. I've put the most recent 4 years here to kind of give some kind of basis to project into the future. And then we're going to use that to project into the future here, which I'll walk through with you guys. And then we have the 1 minus the tax rate here, which is based on the corporate tax rate we've used. The depreciation and amortization, which are real figures from the balance sheet for these 4 years. The capital expenditures, also real. And the net cash working capital, which is actually the current assets subtracted from that is cash and current liabilities, which gives these. And they're positive, but we put them in as a negative here. So just before we start, I will let you guys know that here I used the previous 4 years kind of as a proxy for growth for these next 5 years. So here we've got real data on EBIT and the 1 minus the tax rate, which we've already gotten here. The depreciation and amortization, the capital expenditures, as well as non-cash working capital. And how this is actually calculated is right here. So it's current assets minus cash and equivalents minus current liabilities. And we use the AMD balance sheet for year-end 2022 to calculate these values. So you can go ahead and do that. There'll be a link in the description, as well as the document in our Google Drive, where you can find a link to their financials and download them yourself. So before we do this, what we want to do is actually extend this in terms of growth into the future. So when we look at the average growth rate of EBIT and depreciation and amortization, it's pretty unsustainable. We have about 163% in terms of EBIT, and then D&A are growing by about 45% per year. This is based on those 4 years. Even if we take a 50% haircut, this is still pretty unsustainable in my mind. So we decided to use the NASDAQ 100 in terms of their previous 30 years of growth, which is 16% per year. And so we're going to use this to extend this into the future. So we're going to take this previous year here, and we're just going to multiply that by 1 plus that 16% here. And that's when we get this. And we can continue doing this. My bad. We have to lock this cell. It's always good to just double check that you lock them. And again, this is a more sustainable way for growth. And we'll do this same thing here. And again, just lock that cell. Okay, so now we have everything we need to do our free cash flow analysis. We have all our cash flows here since we've already calculated it. But I'll just do it again to show you guys how it's done. So in order to get this value, let's just empty these here. The way we do it is we have EBIT, and we want to multiply this by 1 minus the tax rate, since this is the amount that we're keeping after taxes. Now D&A, the reason we're not using full EBITDA in this case is because depreciation and amortization are tax deductible for a company. So that's why we're not including it in this first bit. So if we multiply this by 1 minus the tax rate, and then we add on the depreciation amortization, we subtract CapEx, which in this case would be adding since it's already negative, and we subtract the non-cash working capital. Again, it's positive here, so because it's negative, it's going to become positive in this equation. So that should give us our free cash flow for 2019. And again, we can extend this all the way to our time horizon in 2028, which will give us our full free cash flow dynamic here. So now the next order of business, or step 2 here, we want to calculate our cost of equity and our weighted average cost of capital. Both of these we're going to need further along in the valuation. So for cost of equity, I've put the equation here, which is the capital asset pricing model equation. If you haven't seen that video yet, check it out. It's a great one as well. It gives you a good oversight into how we use the CAPM and why we use it. So here we'll use the risk-free rate, which is that RF there, which is going to be the treasury yield here, plus the beta of AMD, which is 1.95. And just as a reminder, beta is 1 for the market, which shows that this is a fairly risky stock. And then we want to do the market return, which is that S&P 500 return, subtracted from the risk-free rate. And so we get 12.28%, which is our cost of equity. Now I've done some calculations here already. You guys have access to this template, so you can mess around with it if you'd like. So here we can see that this here is already calculated. So E and D is simply the value of the firm's equity and the value of the firm's debt added together. And here we just have the equity share of the firm and the debt share, as well as the cost of debt times 1 minus T. And this is just to make this calculation a little bit easier. So all we're going to do here is just do exactly what it says here. So we want to do this multiplied by the cost of equity, which is going to be right here. And we're going to add that to the debt share multiplied by the cost of debt. And then we want to multiply that by 1 minus the tax rate, and that's already done here. So there we go. So our weighted average cost of capital is 11.89%. Perfect. So now what we want to do next is we want to calculate the terminal value. So while we're doing that, there's a couple different methods. So The first one is the exit multiple method. And we'll start with this one. Again, I'll include the notes. We did a full step-by-step DCF walkthrough a couple of months back. And so I'll include the notes for that in the Google Drive as well, so you guys can follow along step-by-step how exactly all these are done. So here, we're going to use year 10 EBITDA, which is just going to be the EBITDA here. It's going to be EBIT plus the depreciation and amortization in year 10. So that's our figure right there. And again, this is in millions, didn't forget that. So this is about 16.98 billion. And so to calculate the terminal value here, what we want to do is follow this equation here. So we want to do the year 10 EBITDA, which is right here, multiplied by that EV or enterprise value divided by EBITDA figure, which is right here. And we have this at the top here as well. So when we hit enter, this is our terminal value that we arrive at, which is about 396 billion. And now I want to use another method just to kind of be rigorous and test exactly how far off this terminal value is from this one, since they're quite different approaches. And so for this one, we're using the cash flow in the last year of our valuation, which in this case is 2028. So we want to do that. So we're going to grab this cash flow right here, and we're going to multiply that by 1 minus the growth rate, which in this case would be the growth of GDP, or 2% in this case. And then we want to divide that by the weighted average cost of capital minus that growth rate again. Okay, so there's our other terminal value. You can see it's quite a bit different. Here I've just already hard-coded an average of these two to give us kind of a more concrete figure. And now finally, we're going to calculate the enterprise value, equity value, and the fair stock price. So this is where things get interesting. So first things first, we need to calculate our discount factor, which is probably the most important part, and a part of the reason why we actually derived the weighted average cost of capital here, which is going to be 1 divided by 1 plus the weighted average cost of capital, which is also our discount factor. So there we have our discount factor. And now we want to calculate discounted cash flows. So now what we're going to do is use this cash flow that we already got from the free cash flows in the step 1. And we're going to multiply this by the discount factor and take it to the power of the year in which we are. So in our case, we'll be doing 2019 as year 1, going a little bit back in time, but using it so it's more accurate here. So again, we can lock the discount factor. And then we can simply drag it across and get all the discounted cash flows. So you can see it's still referencing that discount factor. So in terms of the discounted terminal value, we're using this average terminal value here, and we're doing the same thing. So we just want to have the discount factor to the power of 10, which is the terminal year. And there we go. And now we can go ahead and calculate our enterprise value. To do this, there's a couple different ways, but since we already have the information we have here, all we want to do is sum all of the discounted cash flows over our entire horizon, as well as to our discounted terminal value as well. So this gives us our enterprise value. And now to find the equity value of the firm, all we want to do is we want to use this enterprise value, and we want to add all the different kinds of cash and cash equivalents. So we have cash here and cash equivalents or marketable securities. And then what we want to do is subtract all kinds of debt, which in this case, we just have long-term debt. So there we go. That gives us our equity value here. Okay. So now in terms of total shares outstanding, the current outstanding shares as of year-end 2022 was 1.615 billion. So these are the outstanding shares of AMD. And now in terms of finding a useful metric, which is the fair price per share, all we want to do is we want to divide the equity value in millions by the total outstanding number of shares. What we want to do here is we want to convert this to millions, which is just going to be 1615, to keep it in line with this value here, since this also is in millions. So now in order to find the fair price per share, all we need to do is divide the equity value by the total number of outstanding shares, since that gives the total value of the firm in terms of equity, divided by the total number of outstanding shares, which here gives us 71.78. Now the current share price is 97.84. So because our fair stock price is actually lower than the current market price, this concludes that it is in fact overvalued. And this makes a lot of sense. AMD is a growth stock. So in many cases, it will have exponential growth, but the actual value of the stock due to its growth is a lot less than in terms of its growth, what the price currently is. Now, there is an exception due to us being in some sort of bear market right now with tech firms doing quite poorly. So I would imagine that normally this would be a little bit higher and there would be a bigger discrepancy between the two figures. But here you can still clearly see that it isn't quite on par, and so it's quite overvalued at its current price. So thanks so much for watching, everybody. I hope you can use this tool. I've got all the tools here in the Google Drive, so if you guys want to take a stab at this and try it with any different company or any company you're looking to invest in, all you need is their financial statements, just some due diligence, a spare hour or two in your day, and you're set to go. So thanks so much for watching.